Good morning, everyone. Paul Duncan with GammaEdge here. Today is Wednesday, the 30th of March. Let's go ahead and jump in. Banner day yesterday, as most people are aware. We did have a green light for yesterday, and it followed through. On the SPX, relative to yesterday, we're looking at what we call the winged charts. This shows the cumulative net negative gamma as well as the net positive gamma. And although the scale units are not necessarily important, you can see that we moved a significant amount from about 80,000 here up to over 100,000. Again, don't worry about the units per se, but just note that when we see a drop in the negative side and an increase in the positive side, calls are being added, short-term calls adding to positive gamma within the complex, and price generally tends to follow where gamma is moving. And we saw that yesterday. So positive here on the SPX, the SPY, major move up in terms of the overall values. You can see 140,000 here, relative number. Again, don't worry about the units. 300,000 here. Huge jump up on the call side or the positive cumulative gamma side. The Qs. We did go from a slight negative condition to now a positive condition. So we've crossed the transition here. We are in positive gamma territory. First time in a long time on the Qs. Technology is catching the bid, and that's good. On the IWM, we actually are seeing the same thing. We're seeing a drop now where we are catching a bid on small caps. Still in a net negative gamma condition. The red wing is greater than the green wing, but you can see progress has been made relative to yesterday, and that's a good thing. When we take a look at the 0 DTE, we're going to throw a little bit of a cautionary light on here, and I'll explain why here in a second, but you can see that overall from the SPX and then the index equity settled SPY, Qs, and IWM, we've got net positive gamma expiry for today, and you can see that the price is above what we have marked here as the highest call gamma exposure, and this is the green dotted line that you see in each one of these. Why that's important is that all of these calls are in the money, and while it's not necessarily a driver on the SPX, it is a driver generally on the equity settled index ETFs, the SPY, the Qs, and the IWM, meaning that since they're in the money, most people will elect to take those profits. When we take those profits, we tend to see some downside pressure as the dealer responds. If you don't know why that is, come on into the Discord and ask some questions here. But for this reason, we're going to put a short-term yellow on this. We do anticipate a little bit of downside pressure. May or may not occur, but we do think that the monetization of the in-the-money calls could put some downside on the overall indices today. Different chart than we normally present, but I did want to show that this is the 52-week new high, new lows, and measure of breadth. And basically the green bars show that when we're hitting 52-week new highs and then 52-week new lows, and the red obviously is the new lows, and we've just been getting slammed as the SPX comes down. We've just been getting slammed against that down rail, that 52-week new lows. For the first time in a long time, back from the 12th of January, we are seeing a positive on this. This is the first time, and we think this is significant, but note we could revert back. So just be aware, breadth is improving, and you'll see that. But it is not a guarantee that we're going to sustain this bull. So just be aware that history could rhyme as we go forward here, and we could actually see a failure here coming up in the next week. So just be aware. When we take a look at the market model, we do look at that 52-week new high, new low. This is the first return, as I said, of the new high since 112, and you can see that we had a fairly dominant 52-week new high showing yesterday compared to all the previous days, again going back to 112. We feel that is very significant. The afternoon session, again, showing this what we call linear up. This is the filtered cumulative tick. And what this is basically showing us is that we had sustained buying across the board in the form typically of sweep orders, and they're being presented to the exchanges faster than we can fill, and that's what's driving price up. And this is this cumulative tick is just basically showing us a sustainment for many hours actually of buying, and this has to be in the form of very, very large orders being presented that are basically chasing price upward. Another key thing, we do have an initial bull confirmation. For those of you who understand this, this is called the cumulative tick ribbon. And the ribbon is a series of moving averages which have represented failure in the past. The fact that we are getting the shorter moving average, this red line, to cross the slower moving average is a positive sign. This is necessary to continue, so look for a continuation pattern where the instantaneous white cumulative tick does remain above the ribbon, and if we see that, keep buying the pullbacks, and we should be all right. But because of this being overextended, we actually are quite overextended relative to history. It would be nice to actually see a little bit of a pause today. For that reason, we're going to throw a yellow on here, but nevertheless, very bullish indications here, and this linear up is something to always watch for. When we take a look at Vol and the VIX, we saw Vol actually drop yesterday, and that's good. That reverses this pattern that we were getting ready possibly to enter a spread and see a reversal. Didn't materialize. You can see that we actually dropped in the VIX yesterday. For that reason, for the longs, we're going to color this green. When we take a look at the ESM, the June contract, basically we're just having a shift of the entire complex up. The zeros are coming up, positive gammas moving up, positive trans moving up, etc. So when this happens, think of a balloon. The entire centroid, or the middle of the balloon, is just moving up as calls are added to the overall complex. Taking a look here at the expiration, these bars represent the net gamma per expiry. And you can see a couple things emerge. Yesterday we had almost all green across the board here. We are seeing the 331 expiry rear its negative head again. Not to be necessarily worried about that, but this could present kind of a short-term zero in here where the dealers may want to hide. Gamma exposure as we cross into this area could be net negative for the expiry, and could basically take some pressure off of them. So anticipating today and tomorrow, perhaps one of the trajectories we could go on is actually a sideways action as we hide. But across the board, dominance of net positive gamma, you can see by the green here, especially with the April expiry sitting out here. When we take a look at the net GEX by strike, it's kind of a roadmap of where we are. We're sitting up here. Yesterday we were down lower, of course. We breached the 4,600 level here, and you can see that the dominant GEX has now moved up to 4,650. That becomes the new line in the sand, the new target for the upside. 4,700 sitting right here, which actually is not too far from where we were at the end of December, so it's kind of interesting. I note a little bit of negative gamma emerging here, 45.95. The JPM hedges will come off by the end of day tomorrow. This will all vaporize, especially with the copycat sitting here at 45.20, and we are calculating a zero right around here at 44.70, and you can see visually why that would be. Taking a look at the 0 DTE as the final slide here, we are looking at a single expiry here. It is net positive gamma, as I showed at the beginning with the wing charts. Fairly significant amount here. The 46.75 level is the dominant expiry for today. If we push north of that into the close, we could actually push higher, and we could get a continuation of the run. And the reason for that is that all of these calls will be in the money, and you can see there's a significant level here relative to the primary expiry that we're showing today at 5,800 calls. Downside, this 45.95, 4,600 level is a nice clean transition. That is a natural zero for the expiry today. We've seen in the past where the dealers tend to hide if we do get a monetization across all the other indices. This type of transition zone is a area where the gamma exposure does collapse to zero. That's why we call it the zeros. And as a result of that, we always want to keep an eye on what this target is. We have seen the markets move to these zeros on expiry days. Downside 45.50 becomes pretty much the dominant liquidity area to the downside. We're not anticipating anything to breach this. We're not even expecting to come south of the transition today. But if we do break the transition here at Circle 5 and drop, we don't think we're going to be into the close anything below 45.50. So that's it for today. If you have any questions or comments, feel free to join us here at www.gammaedge.us. That'll take you to a sign-up page for our Discord. We've got a great group of people there, a lot of traders, a lot of experience levels, so feel free to come on in, ask your questions. A lot of people will be able to answer them, including us, of course. You can follow us at GammaEdges with an S on Twitter, and of course you're watching this off YouTube. If you like the content today, please like the button and subscribe so you get notified of the next posting. And with that, make it a great Wednesday, and good luck to everyone.